most misunderstood parts of having a mortgage, which is amortization. What is amortization? Every payment has two parts to it, the interest and the principal. The percentages of those two change over the life of the loan. Okay. At the beginning of the loan, you are paying more of that interest. And as you pay that loan, that interest is very, very top heavy. So if you think about it on a scale, like that interest is going to go down. Okay. But in the beginning, you're paying a lot of it. So in the very beginning, and the principal, you're just edging like right into it. So imagine like a little graph. So you're always edging into that principal as well. So at the beginning of the loan, that is what is going on. Later in the loan. Yeah. And then let's see. As time goes on, the opposite begins to happen. As I was starting to explain there, more of your payment starts receiving that principal and less will go towards interest. Every payment builds something. So as you are paying your mortgage, you are getting that balance down no matter what. And also the equity is building up. So this is great. So as time goes on, your home appreciates and that mortgage balance is going down as well. So you have two factors working as long as the market is up and coming in your area. But typically, what I see over time is that market value does go up. Now, equity goes up, which is a great thing for you as a homeowner. You always want to be in the know when it comes to your equity and just knowing what opportunities are out there and when you might actually need to dig into it. And if you don't ever need to dig into it, that's okay. Just being knowledgeable when it comes to your equity can give you some peace of mind. Just with anything you have going on in your life and yeah. So every payment is doing something behind the scenes. It's reducing that mortgage balance and helping building that equity. And that's why understanding amortization really matters. Extra principal payments, can they help? Yes, they can help. So and this is one of the questions that I hear, should I make extra principal payments? Well, the answer does depend on your goals. Obviously, I talk about this all the time. We are all on different timelines. Okay. So paying extra towards the principal may reduce that interest and shorten the life of the loan. So as life happens, I mean, you could be preparing for retirement, and maybe there is a want to get your home paid off within this set amount of time, 10 years or whatever the case may be. So you really want to know how much extra do I need to be putting towards this mortgage to get it paid off in the 10-year time frame that I'm looking for. And I always say this. It's better to be safe than sorry. So, when you are also looking into making a mortgage move, say if you're looking at a lower term, sometimes it might just make more sense to go with your 30 year, have a low payment, pay extra on it from the get-go, because as you pay that, you know exactly what your timeline is. And say if something does come up, as far as, anything can really come up. Maybe you need something for your car. Maybe one month it's another need that happened. Maybe you have an emergency or you may want to help a family member. I mean, anything can happen. There's always a need for cash or money. And say if you're making that extra principal payment, then yes, you can take, your foot off the gas and pay what you need to pay as that minimum payment. So it's totally up to you. Now, extra principal payments, I've had clients where we are looking at a lump sum payment for the year. Maybe there's a bonus that a certain client gets, and they just want to apply that to the mortgage to see if that's going to make sense for them and their family. Well, it may or may not, just depending on the goals. Look 2 years, 5 years down the road if it's really going to be worth it. Consider, is this a forever home for me? Or am I only going to be in this home for a couple more years? And even then, it might make sense because getting the balance paid down might help. But knowing where you're at in the mortgage is always going to be a good thing. Okay. So, amortization helps you understand. Understanding amortization isn't just about the math. It helps you understand why refinancing may or may not make sense at the time, how equity builds, and how your mortgage changes over time. Okay. So again, it can help you understand refinancing. Well, is this refinance going to make sense for me since I do plan on moving out in 5 years? Okay. Want to make sure you're looking at your recoup and equity. So looking at equity, is it going to make sense for me equity wise? Interest. So, is it going to make sense to pay this interest down just based on my goals, this and that? And long-term planning, retirement, or maybe you're going to be an empty nester soon. I hear all kinds of things. New baby, new home, forever home. We all have different things going on. All right. I think you can understand that. Okay. So we'll go over a simple example here. So imagine a $300,000 mortgage, and your payment may stay relatively consistent if it's a fixed rate loan. So, as I mentioned, your early payment in your early years, more of that's going to go towards the interest. Your later years, more of that's going to go towards the principal. Okay. So your payment will stay relatively consistent. Payments change only because of taxes or your homeowner's insurance, typically, unless you were to refinance or if you're in a certain type of loan. There are loans out there that do change, not the traditional 30-year traditional fixed rates. So they work a little bit different. Okay. So, how that payment is divided between interest and principal changes over time. So, yep. So you understand here. Also included the simple example here. So, a loan amount of 300,000, an interest rate of 4.99%, and this is all hypothetical here. I am using my amortization calculator that I created here, 30 years. And say, this is the little graph that shows. So say if you were just right on track and you're looking to just understand your equity. And you can find amortization calculators. They have them all over the place here. As well, and I do have it on my website too as well. So typical 30 year, you can see how that balance it just goes down right over time. Okay. And then I also included a example where you were to pay $100 extra on the mortgage, which can save you some money. So say if you're at things, okay, so you just plug in the loan amount, the interest rate, and the loan term extra amount, $100. And this actually will save you a lot, 39,000 in interest. Saves you 3 years and 9 months on the mortgage, okay? So you are going to be paying that. If you are consistent with that extra $100, you're going to be paying that mortgage off. Now, obviously, if you put extra, it's going to be a quicker payoff because you're edging into that principal, which reduces that interest in the long run. So you can see down here the little graph here, original and then the new, and 39,000 saves you 3 years and 9 months here. You can pay off, I mean, you can structure your payment in so many different ways. You can do biweekly payments per your lender, of course. Always speak to a financial professional or lender, broker, so that way you know exactly what's what and what's going to make sense because they can absolutely help guide you through these figures. You can put a yearly lump sum. there are clients that get bonuses and want to put that yearly lump on there, which may or may not make sense, or maybe there's an inheritance or some kind of funds that are coming your way. You just want to pay a yearly lump, which is okay. I've seen that happen so many times. And then a target payoff date. So you can always target. I actually created this uniquely. You can target and see what you need to be putting on the mortgage extra to get it paid off in that frame, and if it's going to be really realistic for you. Okay. All right. So, yeah, common misunderstanding. I've been paying for years. So, something I do hear often, why is my balance still so high? I've been paying for years. And amortization helps explain the why behind it because in the early years, you are paying so much more in interest, and that's the way loans are structured. As you go on, that principal will get paid, but if you want to be strong and make extra on the principal right away, you can absolutely do that, and more power to you if you can do that. In today's environment, I know it's a little tough with the cost of living. So yeah. All right. Knowledge creates options for you. So, the more you know about how your mortgage works, the easier it becomes to make confident financial decisions. And that's exactly why I create these workshops. I have friends and family that are always asking me about certain things, aspects in the mortgage, and I love to explain these things thoroughly so that way you can better understand and know what's going on, what's going to be the best move for me. We're on different timelines, so of course we have different things going on, and that is okay. That's how life goes. Okay, so my goal is never to overwhelm. It's simply to help you understand how mortgage works so you can make these decisions with more confidence and less uncertainty.